Welcome to Neppy Invest the World. We are now in the first week of September. It used to be my favourite month of the year until I became an investor, and then my favourite month of the year transitioned to August just because that's reporting season, and unfortunately reporting season is over. So I think a lot of CEOs and CFOs have taken a deep breath. But I most definitely have not stopped going through all the company's reports. Still got a lot to go through. Might take me the rest of September. But today I want to get a little bit sassy and discuss a company that I'm not sure is undecided whether it has the worst name in the ASX or the best name in the ASX. And that company is Bigtincan. So Bigtincan, yeah, I don't know. Sometimes I think it's a great name because it's just so different. Sometimes I think, what were they thinking? But, it's working for them at the moment. But, I did say I had to be a little bit sassy. Get it? SaaS company. So the ASX code is BTH, and you understand SaaS company, or sassy by the end of there if you just read it forward there. So share price $1.15, and that share price hits a market cap of 435 million. So not too large, not too small either, and it is a SaaS company. So, maybe if you like a fuddy data like me and you have no idea what I'm talking about when I say SaaS, or maybe you are a hip go-getter and you're just going to cringe at what I talk about when I discuss SaaS company. But either way, I just want to talk about what is a SaaS company first. So essentially, SaaS is a subscription cloud-based software licensing. So it essentially is software that is centralized locally, like in the cloud. Users don't have to download it to their computers. They can just access it by accessing an app or something. So that means they can access it any laptop, any computer, anywhere in the world. You can go across the country and access it through that app. It's very capital light, as you would think. And there's many other features or positives about SaaS. It's a very in thing right now. A lot of companies are transitioning to a sort of a subscription-based model instead of the traditional based model, which you just pay for the software and that's it. But what do Bigtincan do? So their software improves, their AI-empowered sales enablement. So that software just improves sales, execution, and I'm not talking about capital execution, I'm not talking about killing people, but just the execution of what they do, sales and all that sort of thing, training and customer service. So now we have a basic understanding of what Bigtincan do. But let's look at some of their financials. So instead of looking at the financial year 20 results, I'm just going to go back in time and look at the previous two Appendix 4C. So those who don't know what Appendix 4C is, a company like Bigtincan every quarter must report a cash flow statement. Cash flow statements, the main thing I get out of this is I look at the trend of receipts from customers. That's the first line there, and I look at net operating cash flow. So that's the last number there. So in April 2020, so that's the quarter ending 31st of March, they released this by the end of April. They had Bigtincan had a receipts for customers of 14.9. So it's not exactly revenue. It's a little bit different, but you can sort of equate it to revenue, almost, and net operating cash flow of $5 million. So that's exciting to me. I am a holder. Disclosure, I am a holder. So that did excite me a lot. Seeing, cash coming in the door, $5 million in one quarter. You could, take it forward and think, 4 quarters of $5 million, that's $20 million cash flow in a year. You can't really do that, can't assume that sort of thing, because if you look at the next quarter, a little bit less receipts from customers, 10.4. I'll get into a reason why, and they weren't actually cash flow positive in operations that quarter. But that does not matter, because I've just got a graph here of the cash receipts from when they listed. So they listed in early 2017. You can just see the upwards trend there. But the cash receipts are lumpy, so some quarters are going to be quite high. and then some quarters going to be the decrease. You can see there from, for instance, April 18 to July 18, almost halved cash receipts. But you actually noticed the July 17, July 18 and July 20, there was a bit of a decrease from the April. So that could be a thing where they sort of bit of less cash coming into the door in the July quarter. But the overall trend is the most important thing here. It's going up. And the other important thing here is in April 2020, they were cash flow positive in operations by 5 million. That's exciting to me because they aren't profitable yet in a yearly basis. So because they're not profitable, can't use traditional stuff like P ratios and all those fancy things. But how do I value, or how do people value a SaaS company? So it's usually based off revenue, not earnings or profit. So the metrics I use to assess a SaaS company, fourth main things is gross margin. So gross margin is just revenue minus the cost of goods sold. Second thing is churn. So I like to see how many of their customers they're losing each month or each quarter or each year. So that's the churn. You like to see them not losing many customers at all. Ideally, you like to see 100%, but I think that's an idealistic sort of expectation. It's never going to happen in real life. There might be some companies doing that. The third one there is the annual recurring revenue. Call that R. And you like to see that increasing a fairly good clip from year to year. And the last thing there is a ratio, taking into account lifetime value of a customer. So that's sort of the expectations of how much value a customer can provide if they continue with the business throughout their lifetime. And that's going to be divided by how much it costs to get that customer. So, for example, if the lifetime value of a customer is $1 and you pay $1 to get that customer, really there's no value in that customer at all. So that ratio, you want it to be traditionally around 3 to 1 or 4 to 1. Once you get to about 5 to 1, you're probably paying not enough. You're not spending enough in marketing. So you want that number to be about 3 or 4 to 1. So how is Bigtincan doing? So this is from their presentation. I got it from page 4. You can see our growth is pretty good. So just take note of that number, 35.7. Just going to write it down there because they did give some guidance for the next financial year. So a really good clip there. We're looking at 50% or 52% compounded annual growth rates of R since financial year 18. So it's pretty good. Organic revenue growth, it's pretty high there. So they do have a history of acquisitions, and in a company which does do a lot of acquisitions, I like to see still some good organic growth, because are they getting growth through acquisitions or are they getting some organic growth too? And I'm really happy they've got that down at around about 38%. MRR retention, which is monthly recurring revenue, that's a churn, so that's 89% churn. So they're maintaining, I'd like to see that above 90%, but I think 89% is pretty good, and they've actually increased that over the last few years. Gross margin, typically a SaaS company has pretty high gross margins, that's around about 85%. You can see the lifetime value of a customer has increased quite substantially over the last few years to 270 million, and that ratio I was talking about is very acceptable, 3.9. I did look at one of the previous presentations focusing on the half-year results, and that half-year results suggested that LTV to CAC ratio is getting up towards 4.5, which may be suggesting they weren't putting enough money into marketing, sales and marketing, which might be suggesting what happened. I'll show you the next slide. And the last thing is the negative EBITDA. So they're not profitable. But I'll go back to that sales and marketing. So they've really ramped up sales and marketing this year and really ramped up product development. You can just see there the difference between those 2 years, financial year 19 and 20 on the left, that graph there. In fact, they've doubled their product development and they've increased sales and marketing by 50%. So they're really ramping up. I suppose you could say what they're paying, the leverage, I suppose, operating leverage. So what I like to see here in terms of operating leverage is that bottom number there. So you can see it going down from financial year 16 to financial year 19. So I like to see that decreasing. So then I like to see that all that means is the operating revenue is increasing by more than the increase in sales and marketing product development. So there was that trend up until this year, and now it's gone back up. And that's because of that rapid increase in sales and marketing product development. So we want really some operating revenue to really start to increase at a bigger clip than those two, sales and marketing and product development. So I think next year is going to be important here to see if that the spending in those two things adds value to the company. And this is their guidance. Remember the number 35.8 was their annual recurring revenue for this financial year, and they're forecasting between 49 and 53. If they get to the high side of that, 53, that is 50% growth again. So if they can get that, that'd be amazing. That'd be great. And the most important thing now for Bigtincan holders is they have to get to these numbers. If they exceed these numbers, we'll see a re-rating. If they fail to get these numbers, we'll see the share price fall back over the next few months or so, or whenever they give out any sort of guidance. Okay, and the last thing I'll just show you is the graph. So if you go to the far left, so it goes from November 18 to current. We've seen a good upward trend. So I bought around that 30 cents or so. So I bought actually right here, just above 30 cents when we saw a bit of an uptrend. I have been in and out, but I've maintained a bit of a holding. I actually also partook in a capital raising recently. I think it was about 80 cents or so. I was going to sell at $1. And the reason I was going to sell at $1 is you can see this red line here. So that's actually the dollar line. You can see it's reached $1 3 times and pulled back. So that dollar was a resistance line. So each time it got to $1, it came back. And that's the power of whole numbers. People just think, oh, it's got to $1, I'm going to sell out now. And it did that 3 times. Really good buying opportunity during the COVID virus. Got down to nearly 25 cents, and that would have been very good value there. I should have bought in, but I didn't. You can see there's almost a ascending triangle. So if you go to this pink line, each time it got to $1 and then pulled back. That pullback wasn't quite as low as the previous pullback. So this one went all the way down to here. The next time I got to $1, it only got down to 70 cents. Next time I got to $1, it pulled back to 85 cents. Next time I got to $1, it just went straight through $1. And the reason it went straight through $1 is the annual report, the financial statements, and the market really liked it, and it just pushed through on really good volume. So that's it for now. Looking forward to what Bigtincan can do over the next few months, next few years. And just remember, I'm not a financial advisor, and if you do need financial advice, make sure you speak to a professional and they will give you hopefully some good advice. Until next time, I'll talk to you later. And this is Neppy Invest the World.